Hi everyone. Before we start, let me walk you through the steps I'll use to analyze Afcons Infrastructure. This will help us stay focused and ensure we cover all the critical aspects from both a business and investment perspective. We will break the analysis into two key parts: business and financials and investment perspective. So as part of business and financials, we will take a look at the macro environment and broader push towards infrastructure in India. Then we will move into the company overview. We will see who Afcons is, their history, and their presence in the market. Next, we will examine their order book and execution capability. We will also look at revenue trends and profitability to understand their financial performance over time. To round off this section, we will do a quick technical chart overview to see what the price action suggests for a market from a market standpoint. Then we shift gears into the investment perspective. Here we will explore Afcons' strategic vision and project focus. We will also look at key risks and challenges, what could go wrong or slow them down. Next, I'll give you a snapshot of their fundamental ratios to understand how they stack up financially. And we will summarize the pros and cons and finally wrap it up with my investment view. I'll tell you whether the stock is worth tracking, avoiding, or diving deeper into. So stay with me, guys. By the end of this video, we will all have a clear, well-rounded perspective on Afcons infrastructure and get to know where it fits in the investment radar. India's infrastructure transformation is in full motion, linking remote regions, modernizing cities, and connecting India to the global economy. At the heart of many of these efforts is Afcons Infrastructure, a leading engineering and construction company that has been quietly building some of India's most iconic and complex projects. Afcons brings over 6 decades of experience in executing large-scale infrastructure across rail, metro, roadways, bridges, tunnels, ports, and marine structures. Its footprint extends beyond India with successful projects in Africa, Southeast Asia, and Middle East, showcasing the company's global competence and capability. From the Himalayas to underwater corridors, from urban flyovers to deep-sea ports, the company is known for engineering under extreme conditions, delivering quality, safety, and sustainability. Now let us take a step back and ask, why does infrastructure matter from an investment point of view? So infrastructure is a tangible, long-duration asset class. It generates predictable, stable cash flows and often includes inflation-linked returns, especially in regulated projects like highways, utilities, and ports. It's also less volatile than sectors like technology or cyclical consumer industries, making it a valuable part of a balanced long-term portfolio. Most importantly, infrastructure is closely tied to India's economic strategy. Programs like Gati Shakti, Smart Cities, and National Infrastructure Pipeline are fueling sustained demand across transport, logistics, energy, and urban sectors. So this creates a decade-long visibility window, which is something rare in most sectors. So in financial year 2025, the Indian government has announced a record rupees 11.11 lakh crore capital outlay for infrastructure, which is a major vote of confidence in the sector. Here's how that spending is being distributed. Rupees 1.62 lakh crore for highway development under Bharatmala. Rupees 25,000 crore for metro rail expansion in Tier 1 and Tier 2 cities. Rupees 10,000 crore under Sagamala for port modernization. Rupees 16,000 crore for the final phase of Smart Cities mission. And additional investment in urban water systems, river transport, and border infrastructure, totaling over rupees 1.7 lakh crore. So what does this mean for Afcons? It means opportunity across multiple verticals. Afcons has proven expertise in highway, tunnels, and elevated roads that align with Bharatmala. Metro systems, urban flyovers, and water tunnels supported by Smart Cities and Amrut. Marine and port infrastructure under Sagarmala. And strategic infrastructure in tough terrains relevant for defense and border projects. The company also actively participates in EPC contracts, public-private partnership models, and multimodal connectivity projects, all aligned with India's infrastructure priorities for financial year 2025 and beyond. So, taking it all around, infrastructure remains a cornerstone of India's growth strategy and a stable sector for long term investment. And companies like Afcons Infrastructure are not just executing projects, but they are actually helping shape the future of how India moves, connects, and grows. So, with policy support, technical depth, and execution strength, the company is well positioned to ride the next wave of infrastructure expansion at home as well as globally. A quick word about Shapurji Palonji and Company Private Limited. It is a global diversified organization of 15 major companies. They deliver end-to-end solutions in 6 business segments, including engineering and construction, infrastructure, real estate, water, energy, and financial services. They have a dedicated workforce of over 35,000 employees and a footprint in over 40 countries. So Afcons Infrastructure is listed as one of the 16 companies in their website. Let us start with a quick snapshot of Afcons Infrastructure, one of the India's leading engineering and construction firms. The company was established in 1959 and is a proud member of the well-known Shapurji Palonji Group. It is headquartered in Mumbai, India, and continues to operate as a wholly owned subsidiary of Shapurji Palonji & Co. Private Limited. Afcons follows an EPC business model which stands for engineering, procurement, and construction, focusing on delivering core infrastructure projects end to end. On the global front, Afcons has executed projects in over 25 countries, spanning across Asia, Africa, and the Middle East, reflecting its strong international footprint. The company is especially renowned for its complex engineering capabilities, particularly in the area like tunneling and difficult terrain construction, giving it a solid industry reputation. In terms of financial milestones, Afcons went public with an IPO on November 4th, 2024, and is now listed on both the National Stock Exchange and the Bombay Stock Exchange. As of 31st March 2025, the company had a workforce of approximately 3,892 employees, highlighting its sizable operations and manpower. This gives us a well-rounded view of Afcons, a company with deep roots, a strong parent group, and a growing global ambition. Afcons Infrastructure operates across a diverse set of core infrastructure segments with strong execution capabilities in each. Let's break these down one by one. We'll begin with the urban transport, an area where Afcons has deep experience. The company has delivered a wide range of projects, including metro systems, elevated corridors, and underground tunnels. They have played a significant role in city mobility transformations, with key metro projects in Chennai, Bangalore, and Mumbai. Next, we look at marine infrastructure. Afcons is recognized as a market leader in marine EPC. Their scope includes building ports, jetties, breakwaters, and dry docks. Moving on to railways and bridges, the company handles both conventional and high-speed rail projects. Their bridge engineering capabilities stand out, especially in difficult terrains where precision and safety are paramount. Finally, in roads and highways, Afcons has delivered a variety of projects ranging from expressways and elevated roads to tunnels. Most importantly, they operate across both domestic and international markets, underscoring their global execution ability. So whether it's underground metros or offshore jetties, high-speed rail or highway tunnels, Afcons brings a multi-domain edge to India's infrastructure story. Let us now talk about Afcons Infrastructure's execution track record, a key indicator of credibility in the infrastructure space. To date, Afcons has delivered around 450 infrastructure projects globally, a significant number that reflects both scale and consistency across diverse geographies. One of their standout capabilities is in complex tunneling. They have been pioneers in using advanced technologies like hydraulic tunnel boring machines and the new Austrian tunneling method. So both are crucial for urban metro, highway, and undersea tunnel construction. The company also holds strong technical pre-qualifications, which is critical when bidding for high-value government projects in high-speed rail, metro systems, and marine infrastructure. From a compliance standpoint, Afcons doesn't fall short. They are certified under ISO 9001 for quality management, ISO 45001 for occupational health and safety, and ISO 14001 for environmental management, all reflecting a strong commitment to international standards. Finally, they are actively involved in major national infrastructure programs like Bharatmala for highways, Sagarmala for ports, and dedicated freight corridors for rail logistics, demonstrating both strategic alignment and continued relevance in India's growth journey. So, in short, the company combines technical depth with proven delivery, qualities that matter deeply in long gestation infrastructure investments. Let us take a quick look at Afcons Infrastructure's order book as of March 2025 and what it reveals about the company's growth visibility and execution strength. The company currently holds a robust total order book of over rupees 30,000 crore, giving it revenue visibility for the next 4 years. This includes a strong pipeline of active executable contracts. Looking at the sectoral split, the largest chunk, that is 45%, comes from rail and metro projects, which is a key strength area for Afcons. Marine infrastructure contributes around 30%, where Afcons is a market leader. Roads and highways account for 15%, while the remaining 10% falls under other infrastructure categories. Now let's move to the geographic distribution of these projects. 60% of the order book is India-based, showing a strong domestic focus. Africa and Middle East each contribute 15%, while 10% comes from other regions, underscoring Afcons' international footprint. A few more insights help round out the picture. In FY25 alone, Afcons secured order inflows worth rupees 10,350 crore. The book-to-bill ratio is around 2.4x, which suggests a healthy backlog compared to revenue, typically seen as a positive sign for growth. About 70% of the order book is expected to be executed within 24 to 30 months, which keeps revenue flowing in the medium term. Now, looking at the client and the regional mix, the company serves mostly public sector clients, making up 72% of the business, with remaining 28% coming from private or global players. The international share of the business stands at significant 40%, with a particular focus on Africa and the Middle East. So overall, the order book confirms that Afcons is not just well diversified across sectors and regions, but also strongly positioned for multi-year growth with a healthy balance of domestic and global contracts. Let us now evaluate Afcons Infrastructure's execution capabilities. Now, it is important to look at the real-world projects they have taken on, both in India and globally. So these aren't just individual contracts. They are part of national and international infrastructure development programs that reflect Afcons' technical strength, trustworthiness, and global reach. So some key projects in India, the Mumbai Metro Line 3, they are handling twin tunneling and station construction right in the heart of the financial capital. In Chennai Metro Phase 2, they are delivering underground corridor packages which require precision tunneling in densely populated zones. Similarly, the Bangalore Metro BMRCL includes the elevated viaducts and station infrastructure enhancing urban mobility. One of the most technically impressive projects is the Kolkata East-West Metro, where Afcons executed TBM tunneling under the Hooghly River, which is a rare underwater metro segment. Beyond metros, Afcons has proved its versatility. The Ganga Bridge in Patna is an extra-dosed cable-stayed bridge integrating advanced bridge engineering. They've also worked on marine EPC infrastructure for Surat and Vadhavan ports, supporting India's port modernization push. And under the dedicated freight corridor initiative, Afcons is involved in large-scale civil and track-laying packages, strengthening freight rail logistics. Let us shift to some of their international projects. In East Africa, they are working on Tanzania-Uganda Standard Gauge Railway, a major cross-border rail corridor project. In West Africa, they are involved in Gabon port project, building jetty and terminal infrastructure to boost maritime trade. In Bangladesh, they have contributed to railroad integration works for the Padma Bridge Access, a flagship national project. In the Middle East, Afcons has delivered marine breakwater and quay wall structures for the Kuwait Shuaibah port, which is a high-value maritime job. They've also taken on complex design build contracts. The Malay Hul Humale Bridge in the Maldives, involving building a marine viaduct essential for inter-island connectivity. In the United Arab Emirates, they contributed to underground metro tunneling for Dubai's transit expansion. And in Saudi Arabia, the Riyadh drainage project involves urban tunneling using TBM technology. TBM is basically tunnel boring machine, which once again showcased the company's expertise in complex subterranean work. So these projects highlight Afcons' ability to deliver under varied conditions, from high-density metros and under-river tunnels to desert terrain and coastal ports. Each project reinforces its position as a multi-sector EPC contractor with global execution credentials. Afcons Infrastructure has built strong relationships with some of the most prominent public and private sector organizations in India. Its ability to deliver complex infrastructure projects has earned the trust of key stakeholders across sectors. Some of the major clients include Indian Railways, which is India's largest and most vital transportation network, where Afcons has executed numerous rail bridges, tunnels, and track projects. National Highways Authority of India, a co-client for highway, expressway, and tunnel infrastructure, aligned with Bharatmala and national connectivity goals. Reliance Industries, one of India's largest private sector conglomerates, engaging Afcons for specialized infrastructure development. Delhi Metro Rail Corporation, a long-standing partner in urban transit projects, particularly in underground metro and station construction. Mumbai Metropolitan Region Development Authority, collaborating with Afcons on urban infrastructure and transport corridors across the Mumbai region. Kochi Metro Rail Limited, partnering on advanced metro solutions in South India, particularly in tunneling and station execution. Mumbai Metro Rail Corporation, a key stakeholder in Mumbai's metro expansion, especially for deep tunneling and complex engineering. And Kolkata Metro Rail Corporation, India's oldest metro system, where Afcons has contributed to upgrading and expanding the network. So these partnerships reflect Afcons' capability to work across jurisdictions, geographies, and engineering challenges, delivering on quality, safety, and efficiency. Let us take a quick look at the latest fundamentals of Afcons Infrastructure Limited. As of 13 June 2025, the company's market cap stands at around rupees 16,200 crore, and the stock is currently trading at rupees 441. It hit a 52-week high of rupees 570 and a low of rupees 382. The stock trades at a price-to-earning ratio of 33.3, which reflects a moderate valuation for the sector. The book value is rupees 143 per share, giving it a price-to-book ratio of about 3.08. The face value of the stock is rupees 10. In terms of profitability metrics, the return on capital employed, that is the ROCE, is at 19.5%, while return on equity stands at 11%. The stock currently offers no dividend yield. A few areas of concern include a high promoter pledge of 43.5% and rising working capital days, which is now at 115 compared to 72 earlier. The company also reported rupees 474 crore as other income for financial year 2025. So overall, the company looks financially stable with decent returns, although short-term liquidity and pledged shares, they're worth monitoring. Now let us compare Afcons Infrastructure with other major players in the civil construction EPC space based on Q4 FY25 numbers. Now starting with the big names, Larsen & Toubro leads the space with over rupees 4.9 lakh crore in market cap and a PE of 32.4. Rail Vikas, NBCC and KC International also feature prominently. Now compared to these, Afcons has a PE of 33.3, which is very much in line with the sector norms. But what is impressive is the ROCE, which is at 19.5%, which is one of the highest in the peer group. Q4 was a bit weak for Afcons. Sales declined by 11.4% and net profit dropped 23.5% year on year. The stock doesn't offer any dividend as yet. What really sets the company apart is its niche leadership. It ranks amongst top global players in marine, bridges, and tunneling EPC projects. Afcons stands out as a specialized high quality EPC player with solid long term potential. Let us now see the quarterly update. The quarterly sales have stayed in rupees 3,150 to rupees 3,600 crore range. But in Q4 FY25, while sales were rupees 3,223 crore, the operating profit margin dipped to just 9%, the lowest in 5 quarters. The net profit for Q4 FY25 came in at rupees 111 crore, which is down from rupees 145 crore a year ago. So there is some short-term profit pressure. Now, if we see a large figure in the other income, should we be excited or cautious? Other income in a company's results might look impressive, but it is important to know what it really means. So other income is basically a money which a company earns outside its main business operations. So for an EPC company like Afcons, the core business is executing infrastructure projects. So anything earned from interest, forex gains, asset sales, legal settlements, or joint venture payouts, these show up as other income. Now, is it a good sign? Interest income, if Afcons earns interest from cash parked in banks or FDs, it shows they have good liquidity. If Afcons is paid in foreign currency and the rupee weakens, they earn more in rupee terms, a bonus from global exposure. Or when a joint project goes well and Afcons gets its share of profit, it's healthy. It's a strategic return. Now, these sources reflect smart financial management or project success, so they are good to see. But we should be cautious if we see arbitration awards, which is a big payout. It might boost profit for the quarter, but it is a one-time event. It is not a recurring income. Similarly, asset sales, if income comes from selling machinery or asset sales, it is not sustainable and could signal the company is freeing up cash. Now, dependence on other income, if core profits are weak but other income is high, it may mask poor operating performance. So while it adds to the bottom line, it may not actually reflect the business strength. In case of Afcons in Q4 FY25, it reported rupees 164 crore in other income, which is a sharp increase based on how EPC companies operate. This likely includes maybe forex gains from overseas projects, interest income on project funds, or possibly a JV profit share, or even an arbitration award. Now, that is why profits held up even though margins were under pressure. So is it good or bad? It is not bad, but it is not a sign of core business growth either. It helps stabilize profits in a tough quarter, but investors shouldn't rely on it repeating. Now, taking a look at the annual performance from FY21 to FY25 over the past 5 years, sales grew from rupees 9,376 crore in FY21 to a peak of rupees 13,268 crore in FY24, but dropped slightly to rupees 12,548 crore in FY25. Now, likely due to market slowdowns or margin pressure. Expenses followed a similar pattern, ending at rupees 11,192 crore in FY25. Operating profit has been steady from rupees 870 crore in FY21 to rupees 1,356 crore in FY25. The operating margins stayed mostly in the 9 to 11% range. Now, one positive sign is that other income increased significantly in FY25 to rupees 474 crore, which is the highest in 5 years. However, interest costs also went up from rupees 447 crore in FY23 to rupees 629 crore in FY25. So debt levels may need some monitoring. So net profit grew from rupees 170 crore in FY21 to rupees 487 crore in FY25, with EPS at rupees 13.24. Also, dividend payout improved to 19%, which is a good news for the shareholders. So overall, this company has shown steady long-term growth, especially in profits and earnings. But in the short term, margins are definitely under pressure and debt costs are rising. The company clocked a 5% sales CAGR over 5 years and 4% over 3 years, which is a bit underwhelming considering top EPC players typically aim for 10 to 15% growth. But here's the key. FY25 sales actually declined by 5%, which looks bad on paper, but the context matters. Now, probably the year was marked by global instability, trade wars, and project delays, especially in overseas markets. So this drop may not actually reflect the core execution weaknesses, but more of a tough operating environment. On the upside, profits held steady with a 14% CAGR over 5 years and 6% year-on-year growth in FY25. Now that's impressive considering top-line pressure. It shows Afcons is managing costs and execution well, so it may be considered a sign of internal strength. The return on equity averaged 14%, which is healthy. In FY25, it dipped to 11%. Not ideal, but still within an acceptable range for EPC firms. So for context, we may consider 12 to 15% ROE as strong, 10 to 12% as acceptable, and below 10% we may exercise caution. So since Afcons is listed on National Stock Exchange and Bombay Stock Exchange, so we can track how these fundamentals are priced in and whether there is a case for future valuation re-rating, especially if global conditions stabilize. Let us now take a look at the cash flow. We know that operating cash flow is the real cash which is generated from the core business. In FY25, Afcons reported a negative 132 crore in operating cash, which is a major red flag. That means cash is going out faster than it is coming in. Now, likely causes may be project delays or cost overruns. This gap was plugged through borrowings or equity infusions. Now, in the long term, this is not sustainable. Taking a look at the working capital. Now, working capital is basically how cash flows through the projects. Inventory days dropped from 148 to 43. In EPC, typically this shows how long construction materials or equipment sit before use. Now, lower figure means faster project execution or tighter material control. The debtor days stayed around 81. Now, debtor days is how long it takes to collect payments from clients. Now, this is crucial for EPCs. Payable days fell from 393 to 151. Now, this is a negative. This means Afcons is paying vendors faster and it is basically squeezing its own cash positions. Again, the cash conversion cycle worsened from negative 160 to negative 27. Now, this reflects how quickly the company turns project costs into cash. Now, this is slower. Also, the working capital days jumped to 115, which is again a negative. It means more cash is stuck in operations. Now, this reduces the financial flexibility. Taking a look at the balance sheet, equity capital rose to rupees 368 crore. Likely fresh funding. Now, money raised from the shareholders during listing may be the reason. Now, reserves climbed to rupees 4,893 crore. Borrowings held steady at rupees 2,343 crore, and other assets increased. Now, this basically means more money is stuck in receivables or advances. The capital works in progress, that is the CWIP, dropped. So this implies slower onboarding of new projects. It is basically the money which is spent on projects still under construction. The return on capital employed, that is the ROC, it remains strong at around 20%. So the takeaway is in FY25, cash flow, as far as this company is concerned, cash flow is a concern. Business isn't self-funded right now. Working capital pressure is rising, especially due to faster vendor payments. Balance sheet is solid, but cash liquidity is under stress, and ROC is healthy. Um so overall, we can say the company is stable and well managed operationally. But we can watch for a rebound in cash flows and tighter execution before getting too bullish on this. Let us take a quick look at how Afcons Infrastructure's shareholding pattern has evolved over the last decade. This tells us who really owns the company and how investor confidence has changed over time. First up, promoter holding has come down gradually from 60% in financial year 2015 to 50.17% in FY25. This shows a steady reduction, slow and steady reduction. This could be due to strategic funding rounds or stake sales to institutions during the pre-listing phase. But here's what matters. The promoters still hold a majority stake, which signals strong control. That said, investors should note that 43.5% of the promoter holding is pledged. This means a significant portion of the shares is being used as a collateral, possibly for group level obligations. While this doesn't automatically spell trouble, it does increase the risk, and it's something that we all should watch out closely. Talking of institutional ownership, foreign institutional investors have increased their stake from just 10% in FY15 to over 18% in FY25. Domestic institutions also raised their exposure from 5% to 12.07% over the same period. So this rising institutional interest is a positive signal. Public shareholding has declined from 25% in FY15 to about 19.55% in FY25. This drop is likely because of increased institutional participation, crowding out public float. For retail investors, this means limited availability of shares, which can affect liquidity. Taking a look at the insider transactions and block deals in FY25, in January 2025, Shapurji, Palonji and Co., the promoter group, acquired about 3.2 lakh shares in an internal transfer at rupees 430 per share. Now, this move shows continued promoter confidence and internal realignment. In March 2025, senior employees were granted ESOPs under a 3-year vesting plan. That shows the company is focused on retaining key talent and aligning their performance with the shareholder value. Now, importantly, there was no selling by promoters or key management personnel during FY25. Promoter holding stayed stable at around 50.17%. On the institutional side, the notable block deals which took place was one in December 2024 before the listing. A domestic institutional fund picked up shares worth rupees 75 crore from a group entity. In February 2025, a strategic block sale saw shares placed with high net worth investors at around rupees 450 per share. So again, reflects a growing demand from informed investors. Now, during a Q4 25 period, the stock traded in a tight range between rupees 430 to rupees 460. Afcons is currently trading around rupees 440.85. This week, it moved between rupees 434 and rupees 460 with a mild uptick of about 1.3%. The price action looks sideways, with investors watching but not acting aggressively. That is usually a sign of consolidation, a healthy pause after earlier gains. Talking of the 52-week context, the stock is holding well above its 52-week low and remains nearly in the upper half of its trading range. That tells us that investor confidence is still intact. Trading volume for the week came in around 8.8 million shares, which is quite okay, but the volume trend has started to flatten a bit, which means momentum is steady but not rising. MACD is currently negative at minus 20.66, suggesting some bearish pressure. However, it looks like it may be bottoming out. If it starts to turn up, that could be the early sign of reversal. The RSI stands at 47.39, right in the middle of the range. That means stock is neither overbought nor oversold. Key levels to watch: on the upside, rupees 460. This is the immediate resistance. If the stock breaks above this with strong volume, we could see a new uptrend. Rupees 480 to rupees 490, minor resistance from the previous highs. Rupees 520 is the medium-term resistance. A close above this strengthens the bullish case. And rupees 570, which is a 52-week high, is a key breakout level in the long run. On the downside, rupees 434 to rupees 440, this is the current support zone. And rupees 425 is a strong near-term support, a good level to watch for a buy the dip opportunity. Rupees 400 is a critical psychological support. If the stock dips below this, it could lead to a deeper correction. And rupees 382, which is the 52-week low, any breakdown below this, it should be a sign of reassessment of the investment thesis. So talking of strategic priorities and outlook for FY26, the company has laid out a focused roadmap to strengthen its leadership across key infrastructure verticals. Urban mobility, the company aims to deepen its metro and elevated corridor capabilities. International projects, the company is continuing to diversify across Asia and Africa, spreading geographic risk and tapping into global opportunities. Rail infra, there is a clear push into high-speed rail and rail electrification, two areas expected to see heavy government investment. Marine dominance, the company plans to further strengthen its position in port EPC and naval infrastructure. The technical advantage, the company continues to invest in technology like the tunnel boring machines and tunneling technologies to stay ahead in the underground infrastructure. While the strategy is ambitious, the company also faces these risks like execution delays. Urban projects are prone to tunneling risks, clearances, utility relocation delays, especially in congested metro zones. Capital intensity, which is like the EPC remains resource heavy. Afcons needs large upfront capital for equipment, while working capital cycles remain stretched. With the recent listing, the company also faces market pressure on valuations and margin visibility tied to project timelines. Operating abroad brings volatility, political risks, and lag in receivables, especially in emerging markets. Sectoral competition, metro and marine infrastructure bids often attract intense competition. This can lead to price wars and compressing margins even for efficient players like Afcons. So zooming out, several external factors also impact the company's performance in the near term. For instance, geopolitical instability. So conflicts like the Red Sea attacks linked to Israel-Hamas conflict and the Ukraine war, also the ongoing conflict between Israel and Iran. These have driven up fuel, steel, and shipping costs. Risk premiums are rising for operations in politically unstable areas like Africa and the Middle East. Elevated interest rates are making infra debt more expensive. At the same time, input cost inflation for cement, steel, and equipment is putting pressure on profit margins. So supply chain disruptions like container shortages, port congestion, and freight delays are affecting project timelines. Longer lead times for imported equipment and subcontractor delays are also creating execution bottlenecks. So overall, Afcons is clearly well positioned to grow with its sharp strategic focus, but investors need to be wary of the operational complexity and global uncertainty that come with large infrastructure business. So before we move on, let us take a bird's eye view of Afcons Infrastructure's unaudited financial results for FY25. Revenue from operations came in at rupees 8,712 crore. EBITDA stood at rupees 1,448 crore, translating to a solid EBITDA margin of 16.6%, which is a healthy sign for an EPC player. Net profit was rupees 545 crore, reflecting continued profitability even in a challenging macro environment. So this suggests that Afcons managed to protect margins and deliver profits despite global uncertainty. Talking of the profitability ratios, the Return on capital employed stood at a strong 19.5%, showing efficient use of capital. Return on equity 11%, and book value per share rupees 143. The company trades at an estimate EV to EBITDA multiple of approximately 9.6, which is reasonable compared to peers. So overall, this highlights solid operating efficiency with scope for valuation upside if the future growth sustains. Now, debt to equity ratio is at 0.83, which shows a balanced capital structure. Working capital days are stretched at 115. This aligns with earlier concerns around cash flow tightness. Promoter holding is 50.17%, but key concern is the high promoter pledge. So this is what needs to be monitored. Order flow and coverage for FY25, the order inflows totaled a strong 10,350 crore. The company's order book is 3.5x its annual revenue, giving clear earnings visibility for the next few years. Importantly, 40% of the order book is international, that is supporting diversification and forex-based revenue streams. Now, this robust order pipeline indicates strong execution potential, provided working capital challenges are addressed. So, Afcons ended FY25 with healthy profits, strong order inflows, and a balanced capital structure, but with a few flags, especially the promoter pledge and tight cash cycles. Talking of the senior management, at the helm is Mr. Shapur Mistry, who brings strategic direction and leadership from the Shapurji Palonji Group, backed by decades of industry expertise. Mr. Subramanian Krishnamurthy provides high-level executive oversight, ensuring strong governance and long-term planning alignment. He is the executive vice chairman. Mr. Param Sivan Srinivasan, he is the managing director. So, as a managing director, Mr. Srinivasan leads operations with a proven track record in delivering large-scale EPC projects. Mr. Giridhar Rajgopalan, deputy managing director. Mr. Umesh Narayan Khanna, he is the non-executive director. Mr. Khanna offers strategic inputs and board-level guidance from an external perspective. Mr. Anurag Kumar Sachan, he is the independent director. Mr. Sachan adds depth in public infrastructure governance with a vast experience in the rail sector. Mr. Sitaram Janardhan Kunte, he is also an independent director. He is a seasoned bureaucrat. Ms. Ruxana Mistry is also an independent director. She supports the board with a strong background in compliance, ethics, and corporate governance. Mr. Chirag Balsara, another independent director, he brings legal and regulatory expertise, ensuring robust decision-making and oversight. Mr. Atul Sobti, again an independent director, he enhances the board with leadership experience in PSUs and defense sector infrastructure. So together, this board represents a balanced blend of execution, governance, and strategic insight, which positions the company for resilient and responsible growth. So from a retail investor's perspective, board won't drive short-term stock prices, but it is one of the most important guardrails for long-term investor protection. So we can think of it as an insurance, that is, if things go wrong, a good board acts to limit the damage. And if things go right, a good board ensures fair treatment of all the shareholders. Hence, it is important that this board be reviewed critically. So the strengths for this board is that it has a healthy mix of executives, non-executive, and independent directors, which is important for strong governance. Several members like Mr. Atul Sobti, who's former BHEL CMD, and Mr. Anurag Kumar Sachan, who has rail infra background, they bring sectoral expertise, which is valuable for a niche EPC player. And chairman from promoter group, that is Mr. Shapurji Palonji Mistry, ensures alignment with long-term shareholder vision. Potential red flags to watch: the promoter holding is 50.17% and 43.5% is pledged, which is already flagged in the previous portion of the video. While not directly about the board itself, high promoter pledge is a concern, especially if no independent board resistance is visible to counter it. Now, there are all 4 full-time executive roles, that is chairman, vice chairman, MD, DMD. Some might view this as promoter-heavy influence, but for a recently listed company, this could reduce the independence of boards functioning unless it is well balanced by active independent directors. In a company like Afcons Infrastructure, where projects are large, technical, and spread across different geographies, good execution depends on more than just equipment or manpower. It depends on how well knowledge is captured, shared, and reused across the organization. To support this, Afcons has built a structured knowledge management system that helps teams learn from the past projects and apply those lessons to new ones. Afcons uses a few formal tools and practices to manage knowledge. A digital platform called Genesis, which serves as a central space to store and access learning from different projects. Leadership site visits that allow for exchange of ideas and best practices between teams. Structured training programs where employees receive an average of 3.5 days of training each year. A process of documenting lessons learned so that successful approaches can be reused and common mistakes avoided. Standard templates and procedures which ensure consistency and quality across projects. Now, why this matters is it helps reduce rework by avoiding repeated errors. It improves consistency in how projects are delivered. It supports smoother onboarding by giving new employees access to key information. It encourages process improvement and innovation. It also ensures important knowledge stays within the company, even if employees leave. Now, the company also follows a simple model called learn before, learn during, and learn after. Before a project starts, teams prepare using resources from Genesis, along with workshops and e-learning. During the project, they gather feedback from the field, share short videos and expert inputs, and document what's working in real time. After the project, reports and case studies are created and lessons are reviewed for future use. Now, the cycle helps build a library of knowledge that improves over time. So, taking it all around, Afcons has made knowledge management a formal part of how it runs projects. This helps reduce errors, improve quality, and make better use of what teams have already learned. In an industry where project complexity is high and team sizes are large, this kind of system can make project delivery more consistent and efficient. Now let us take a look at Afcons Infrastructure as an investment case, starting with what works in its favor, and then risks, and finally what could move the stock in future. So let us begin with the pros. First, Afcons has a very strong order book, over rupees 30,000 crore worth of projects, giving it revenue visibility for almost next 4 years. Now this is a big comfort for a long-term investor. Next, the company is not just an infra player, but it is a specialized player. It is known for complex jobs like metro tunneling, marine infrastructure, which very few companies can handle. Now, this gives it a competitive edge. Financially also, it is in a good place. EBITDA margins are 16.6% and ROCE is close to 20%, which shows that it is okay. And earns decent returns. Afcons also has a global footprint. About 40% of its order book comes from international projects. Now this helps reduce dependency on the Indian market. It is well placed to benefit from government initiatives like Gati Shakti, the National Infrastructure Pipeline, and Smart Cities mission, all of which should drive demand for its services. And of course, Afcons is backed by the Shapoorji Pallonji Group, a legacy name in Indian construction and infra, giving it both financial and brand strength. Taking a look at the cons, the biggest red flag right now is the high promoter pledge, which is 43.5%. If the promoter group faces financial pressure, that could impact Afcons' stock sentiment. Cash flow is a concern. Afcons reported negative cash from operations and working capital days have been rising. Now that shows there is liquidity stress. Then there's the issue of execution volatility. Because Afcons works on metro tunnels and overseas projects, it's more exposed to delays, approvals, and unpredictable risks. And finally, there is no dividend payout. All profits are being reinvested. So, if we are looking for passive income, then this may not be the right stock. Now, here's what could move the price going forward. Any large project wins, especially in metro, marine, or international markets, will act as a positive trigger. Then, if they manage to reduce the debt or lower the promoter pledge, that will definitely boost investors' confidence. Also, we need to keep an eye on the quarterly results. If sales and profits start recovering, the stock will likely respond quickly. Policy updates and government infra capex announcements, especially around the budget, NHAI or MORTH, will act as a sector-wide catalyst. So here's the final summary. Afcons Infrastructure stands out as a technically strong player in India's infrastructure story, with deep expertise in metros, tunneling, and marine projects. It is backed by Shapoorji Pallonji Group, and now it is listed on the National Stock Exchange and the Bombay Stock Exchange. It enjoys improved market visibility and global project exposure. For existing investors, it is worth keeping a close eye on the cash flow recovery, pledge reduction, and margin trends. For new investors, wait and watch, track how the company settles into the next few quarters, and if the execution improves and fundamentals strengthen, Afcons could benefit from sector tailwinds and peer re-rating over the next 3 to 5 years, and possibly provide us a CAGR of 12 to 16%.